Really appreciate you doing this with us in the middle of the earnings season.
No, I'm looking forward to this.
Before we officially begin, could you give us a brief intro of your investing career for our viewers in Korea?
I certainly can. And before I start, I just wanted to say it's a pleasure to be on with you today. I really, I am so fortunate. I love markets, as you'll hear about, and I've been doing this for a long time now. So my background is I attended Princeton University back in the late 80s, so probably well before most of your listeners were even born.
Oh, I don't know, because my audience is actually pretty old.
But I was really fortunate because I was studying there. I was studying the politics and the economy of this new European Union that was coming together. And remember, that was before the European Central Bank was created. That was 10 years before the euro was even introduced. But I felt like I had this knowledge, and it really shaped my interest in both the markets, but in particular in macro investing.
So how did your interest in the macro markets lead to your first job in the hedge fund?
I joined my very first hedge fund in 1997. So I've now been doing this professionally for 26 years, dedicated to building and managing macro businesses within some of the larger multi-strategy firms. And I feel incredibly fortunate because I have worked for some of the most well-known and what I consider to be, the very best hedge funds on the planet. Firms like the firm that I'm at now, Schonfeld, Citadel, Balyasny. But I've had this front row seat, and I've been able to work with many of the icons of the investing world and to learn directly from them. So I've been very fortunate over my career, and I do love what I do.
Right. So hedge funds. I ask the same question to every hedge fund manager that I interview, and it's actually very interesting how they all give me slightly different answers, but all in very right ways, but just different color. So the question is, what is a hedge fund? So if there's two guys on a Bloomberg terminal managing other people's money and go by the 220 model, the fee structure, can we call them a hedge fund?
I think that there are some 4,000 or 5,000 organizations that like to call themselves hedge funds. Many of these firms like our fee structure, which has been traditionally characterized as the 2 in 20 model, so a 2% management fee and a 20% performance fee in addition to that, although the model is now evolving more towards what they call pass-through fee models. But look, to me, a real hedge fund is focused on generating terrific risk-adjusted returns in all market environments. They focus on hedging, thus hedge fund. They focus on generating absolute returns, so performing in all market environments. That to me is one of the greatest challenges of the investing world. In sports, for example, in baseball, they say that hitting a baseball is the hardest thing to do in all of sports. And I think in investing, generating absolute returns, so generating positive performance in all market environments is the hardest thing in investing.
Colin, so you mentioned earlier in your career, you worked with high-profile hedge fund managers who I think we can call them one of the best risk takers in the world. Since you've worked with them and you are one of them now, what are some characteristics that are common among these great portfolio managers?
Some of the finest risk risk takers that I've worked with, and I've been very fortunate to have worked directly with many of the largest risk takers in the market today. I like to describe them as always having a very humble and quiet self-confidence about them. I think that they are always very respectful for how difficult markets are and how hard you have to work to stay at the top of your game. I think that they are all very intellectually open to finding ways to try to improve. They're very driven.
When I look back, I think the smartest people I've ever met in my life are the ones I met in the hedge fund investing scene. And to your other point, if there's one thing I learned from Wall Street, I would say resilience. The ability to pivot and take on new challenges is more important than anything.
And I would say amongst the hedge fund founders themselves that I've worked with, I would say that they have incredible perseverance. That they understand by nature that you're not always right in this business, that you will sometimes make mistakes, you'll be wrong, and they never use that. They never take those setbacks in a way where they become depressed or anything else. If anything, those events motivate them to become even better, to work even harder, to go figure it out. And I think that perseverance is a very understated characteristic that I've witnessed over time. But I would say all of these people are very smart in their own right, very clever, very hardworking, and really obsessed with the markets. They make that their top priority, nearly in life. Trying to solve this puzzle that is in front of us, but they have a real passion for doing that.
So there are hedge fund managers, the people behind the hedge funds, and then there are the hedge funds, right? The platforms, often in the form of multi-strat with hundreds of billions of dollars in AUM and consistently outperforming the markets. But even among them, there are winners and losers. What do you think separates a good hedge fund from a great one?
I think that's a great question. Separating the good from the great, and what allows that to happen. And the firm that I work for now, Schonfeld, is an interesting example because Schonfeld celebrates its 35th anniversary this year, which makes it one of the longest standing multi-strategy firms. And it's really interesting because Schonfeld, starting 35 years ago, it was a very similar time frame to when Millennium started, when Citadel started, and these are obviously iconically successful firms today. And it's interesting that these founders were all experimenting with this form of business, at almost a very precise moment in time, that 35 years ago. And over time, I think firms like this have developed, very strong competitive moats around them because they are able to do a lot of things very well. They are able to recruit and retain the very best investment talent. They have very sophisticated technology to support their efforts. They have huge data and quantitative efforts. They have fantastic risk management in terms of what they do. And each of them is always constantly innovating, constantly trying to seek out new types of alphas in the market and to find a way to run a higher sharp, a lower volatility to type of business without sacrificing returns. And so what I think is really, does separate the good from the great is having, stood the test of time and having, generated returns over multiple periods, over multiple cycles, the absolute returns that I referred to earlier, and doing a lot of things very well. I think these are, complex businesses, and I think there's a reason that they've all gained in popularity as they have.
About those success factors, Larger managers, with a few exceptions, of course, they've managed well through volatility. Their gains seem to be reflecting a larger phenomenon that's growing in prominence. I think the hedge fund industry is becoming very bipolar. It's becoming more and more concentrated in a small number of larger players, and who are outperforming the smaller ones, the smaller, supposedly the more nimble players. Why is that? And do you think those success factors that you mentioned earlier are the same for the smaller firms?
Look, in the smaller firms, I think that you can still generate outside size returns. I tend to think that there are more capacity constraints, so you can do that on a smaller amount of capital, and you really find a very small edge in the market in terms of what you can be, very top in your game. But I do think that it within a structure like that, just because the cost of data and having, very large quant teams and having the best technology, all of these things take such incredible investments to build out. I think that it is very difficult for them to adopt that type of competitive advantage to their businesses. But certainly you can have a great portfolio manager who is surrounded by a fantastic team of analysts that maybe just focuses on one particular sector of the market. Maybe that's a long short consumer portfolio manager or something along those lines. But I do think that in that structure, it is harder to perform over multiple cycles over a longer period of time and maintain that same type of edge.
Yeah, well, thank you for that. So moving on to your career story, I hope to ask some of the more personal side of the story. So 26 years.
26 years.
Is a long time. What drives you? What makes you not leave the scene after all those years?
As I mentioned, I love markets. I love my job. I think that, in a position like this, I have the luxury of working with incredibly talented individuals, and collectively we're constantly trying to solve problems, and I really enjoy that. I've never been someone who's had a lot of hobbies on the outside. Look, I love spending time with my wife and my 3 daughters, and I like to read and do a bit of yoga, but I don't have a lot of hobbies. The markets are my hobby and kind of my passion. It's where I find a lot of purpose in my life. And so I couldn't really imagine my life without markets and without some exposure to the things that I do on a daily basis. I'm very lucky.
Was the private market ever an interest to you? So we're talking, you could have built your career in the private equity world. So what is so great about the public equities or the public side of the markets? Why was it always so appealing to you?
Yeah, well, in my case, it's even a bit more refined because, I've traditionally managed macro fixed income businesses. So, my businesses have been much more focused in the global rates market and foreign exchange, some commodities, some credit, to a lesser extent in equities. But I would say particularly because I've been focused on global macro strategy and an expression that always relies on the most liquid instruments in public markets. So while I certainly respect and have friends who have made great careers in private equity or in venture capital or in other areas, I have been particularly obsessed by global macro. And one of the reasons for that is that macro, of all of the hedge fund strategies and investing strategies that you can adopt, tends to perform quite well when other asset classes are having their worst performance. As equities are selling off, as you're headed into a recession, it's usually macro that outperforms. And there was something about that always really resonated to me in being the one part of an investor's portfolio that is working well when everything else is not working.
So macro is hard. Public market is hard. Actually, in investing is hard. And speaking of, this being probably one of the toughest job in the world, could you share with us some of the hardest portfolio decision or a business decision that you've ever had to make?
Look, I would say that, the 2008 global financial crisis was certainly the hardest market that I've had to manage through. I've been fortunate in that having done this for 26 years now, I've seen a lot of cycles, a lot of recessions, a lot of scares, but that was clearly a moment in time when we were pushing the financial system to the utter brink of collapse, and kind of the definition of the Minsky moment, or this type of systemic risk that you see. So clearly it was the most challenging because of the combination of an incredible recession that we were headed into, and just a complete evaporation of liquidity, and the fact that any type of credit counterparties were afraid of each other. You would have a benchmark bellwether industrial name that was on the brink of bankruptcy. So it was an environment where everyone was just lost all appetite for risk, was incredibly nervous about any risk taking, and that combination of bear market and zero liquidity is clearly the worst environment you can ever be in.
Zero liquidity and market crash. That is not a combination that our listeners today in today's market is familiar with. And sorry, I'm kind of going back and forth here. Just a little more on your career and personal story. So, hedge fund manager, it's a tough job. It's a tough career, tough market. Do you or did you have a mentor? Or just put it more simply, someone who's had a great influence on you?
Yeah, look, I would say that all of my former bosses provided great mentorship, and that they were people that I learned from very directly. I think the markets business is a business where mentorship is really important. And the reason I say this is I can go on Amazon and buy a great book on bond math or fundamental securities evaluation, but there aren't a lot of great examples of work that tells you what to do on payrolls day when the print comes in super hot and you're leaning the other way. Right. How are you supposed to trade that event? And how should you think about sizing within a portfolio, and in testing your own conviction, and some of these challenges, portfolio construction, sizing, the amount of tactical trading that should be done are really things that I think you need to learn through osmosis, learn from watching other great risk takers, and just studying the things that they're doing, and learning from that. I would say one of the icons of the business that I never directly worked for, so I can't consider a direct mentor, but someone who I've always really admired, and I love it whenever they do a speaking engagement, is he's one of the icons of the macro investing world, but someone like Stanley Druckenmiller, because I love him because he is always incredibly pragmatic about the world, and always just trying to think about the data and what that means. And he never gets wrapped up. He may disagree with, for example, what the Fed is doing, or what the politicians are doing, but he never lets that impact his own ability to generate P&L. He's really able to kind of bucket these things. And look, he's been one of the greatest pure macro risk takers over, certainly over the course of my career, and a bit longer than that. But I would encourage your audience to Google that name and listen to some of the podcasts that he has done, because I think he always has just amazing advice to offer, and he also always offers very clear views on the markets. He's very transparent that way.
Right. Yeah, I'll definitely do that. So those great fund managers, right? The great minds. Do you think it's more about intuition
I think intuition is a big part of it. In part of your question on having a great mentor, I think that is how you start to develop some of that intuition, because I think some of this just it's like going to the gym and getting your reps in, getting your exercise, doing this every day. It builds a certain muscle memory to things. But there were always very famous stories about George Soros that he would get a backache but before the markets would sell off. So and again, I think that comes back to the intuition. I'm sure that because some of what he was looking at and some of the patterns that he was seeing was causing his body to internalize stress that would end up as a backache. But he knew when he had a backache, he needed to sell equities, and equities were going lower, which I think is an amazing story. But to your point on intuition, I do think having studied markets, having studied different cycles, creates this series of warning signals for yourself. And then it's almost like you're on autopilot. Any great athlete, when they're kind of in the zone and just performing better than anyone else, I think it's possible to do that from an investing perspective as well.
To the aspiring portfolio managers or hedge fund analysts, traders out there, what career advice would you give them? Yeah,
look, I think the space offers so many different great career avenues, and I would just encourage them to develop the passion, study, work very hard at it. Look, I think this day and age, and I think we'll talk about this a little bit later with the development of generative AI and some of the newer technology developments, but I think that we are on the cusp of a brand new set of technologies that is going to create just immense opportunities going forward. And, I think about the path of my career and, really kind of going to university in the 80s and thinking how important the late 1970s and the 80s were for the launch of my career, because you had the new introduction of the options exchanges, and Black-Scholes just celebrated its 50th anniversary, a whole new world in derivatives. In the 70s, you had President Nixon took the U.S. off of its dollar peg, which created all these freely floating currencies, which impacted things throughout the 80s. And so you had this confluence of events, both academic research in terms of many of the great Nobel laureates that influenced our space, options trading, free floating currencies, and that really created this amazing backdrop for my career, over the next 20 years. And I think we're in a similar path right now. So understanding the impact that these new technologies can have, how they can be transformative, how people can be expert in them to help drive this forward. Because look, it is this vintage of people that is going to drive that change. I'm the dinosaur now, so I'm the person that will get arbed out in all of this. But I think understanding the impacts that these things will have on the markets is just an incredibly exciting period of time for people studying this now.